Ever wonder how companies decide between like stocks and bonds when they need to, get their hands on some cash?
It's a bit like choosing between a fixed-rate mortgage and an adjustable-rate mortgage.
Except we're talking way, way bigger scale here.
Oh, absolutely. We're talking about decisions that can make or break a company.
And that's what today's deep dive is all about, how those financing choices, debt versus equity, impact a company's bottom line. And to really get a handle on this, we're going straight to the source, the Modigliani-Miller theory.
This theory, oh man, it really shook things up back in 1958 when it first came out. It was a game changer.
Yeah, I bet. It's considered a cornerstone of modern finance, but I'll be honest, it's always seemed a bit intimidating.
I get that. Before Modigliani and Miller came along, economists were treating risk like, like that one friend you try to avoid at parties.
The one who always brings the karaoke machine.
Exactly. You know they're there, but you kind of pretend they're not. It's just easier that way.
Except in the world of finance, ignoring risk is a recipe for disaster.
Exactly. And that's where Modigliani and Miller said, hold on a minute, let's bring risk into the equation and see what happens.
So we're digging into excerpts from their groundbreaking paper, The Cost of Capital, Corporation Finance, and the Theory of Investment. And full disclosure, folks, it's a bit of a brain twister.
Oh yeah, it's dense. But trust us, the core concepts are incredibly valuable. We're here to do the heavy lifting and make it as painless as possible.
Okay, so let's start with the basics. What exactly is the cost of capital, and why should we care?
Great question. Imagine you're a company, right? And you're trying to decide if it makes sense to, say, build a new factory.
Big decision.
Huge. And to make that decision, you need to figure out if the potential profits from that factory outweigh the cost of actually building it.
Makes sense. You don't want to spend $1 million if you're only going to make 50 grand.
Exactly. So the cost of capital is essentially the price a company pays to get the money it needs to finance those investments, whether it's building a new factory or developing a new product.
Okay, but there are a ton of ways to raise money, right? Companies can sell stock, issue bonds, borrow from banks. How do they even begin to compare all those options?
That is the million-dollar question, and that's where Modigliani and Miller dropped their bombshell. They said, forget all the complicated formulas everyone else is using. Let's just look at how the market actually behaves.
Cut through the noise and see what's really going on.
Exactly. And what they found was revolutionary. Their big idea, their proposition I, was that a company's value is based on its ability to make money, its earning power, and not on how it gets the money in the first place.
So it's like baking a cake, right?
Yeah.
Whether you paid for the ingredients with cash or put it on your credit card, you still end up with the same cake.
Perfect analogy. The financing doesn't magically make the cake more or less delicious. It's still the same cake, same ingredients, same value.
So borrowing money, even if interest rates are super low, doesn't inherently make a company more valuable.
Not in the way people thought back then. Modigliani and Miller showed that those old assumptions were way too simplistic.
Okay, that's a pretty powerful concept. But companies don't just raise money once, right? They're constantly juggling debt and equity, trying to find the right mix. How does that ongoing balancing act play into their overall value?
You're thinking like an economist now. And that, my friend, is where Proposition 2 comes in.
Hit me with it.
This one gets a little bit more into the weeds of risk and return, but stick with me. Basically, Modigliani and Miller argued that as a company takes on more debt, the return that investors expect on their stock, that return actually goes up.
Wait, really? I would think having more debt would make the company riskier, not more appealing to investors.
You're absolutely right, it does. And that's precisely why investors demand a higher potential return. They know the company is obligated to make those interest payments on the debt, no matter how well the business is doing.
So it's like if my friend's starting a business and they've already got a mountain of credit card debt, I'm going to want a bigger potential payoff if I'm going to invest.
Exactly. The riskier the investment, the higher the potential return needs to be to make it worthwhile. And when a company takes on more debt, it increases the risk for everyone involved, especially the stockholders.
So it's this delicate dance between risk and reward.
Exactly. And this is where Modigliani and Miller really challenged the conventional wisdom of the time. Back then, everyone thought, oh, debt is the cheap way to go because interest rates are generally lower than stock returns.
Seems logical on the surface.
Right. But Modigliani and Miller said, hold on. You can't just look at the sticker price of debt. You have to factor in that added risk it creates for stockholders.
So it's like you can't just skim the cream off the milk and expect the leftover skim milk to be just as valuable.
Now that is a delicious analogy. You've got it.
Yeah.
They argued that the supposed savings from using cheap debt were completely offset by the increased risk for stockholders.
So even though debt might seem cheaper at first glance, it doesn't actually make the company more valuable overall.
Exactly. And they even had some real-world data to back up their claims. They looked at companies in the electric utility and oil industries, and their findings supported this idea that you can't just game the system with cheap debt.
So they weren't just theorizing in a vacuum. They had evidence to support their ideas.
They did. Of course, the real world is always messier than any model. But their work provided some early evidence that their ideas held water, which was huge. Remember, this was the 1950s. Their work was groundbreaking.
Okay, so we've covered a lot of ground here. We've talked about how a company's value is all about its earning power, not just its financing structure. And we've touched on how risk and return come into play when companies use more debt. But before we get too far ahead of ourselves...
I sense a but coming.
You know me too well. This wouldn't be a very deep dive if we didn't address the elephant in the room, right? Taxes.
Ah, yes. Taxes. The wrench in the gears of every elegant economic theory.
Everyone knows taxes have a huge impact on financial decisions. So how does that factor into the Modigliani-Miller world?
Well, when you bring taxes into the picture, things get even more interesting. And you're right, it's a crucial part of the story. But we should probably save that for after a quick break.
All right, listeners, you heard it here first. We're about to venture into the wild world of taxes and corporate finance. Don't touch that dial.
All right, so taxes, right. We were saying how Modigliani and Miller, their big idea was that a company's value, it all comes down to its earning power, not so much about how it gets the money.
Right, like our cake analogy. Same cake, different way to pay for the ingredients.
Exactly. But, and this is a big but, that whole idea, it kind of assumed a world without taxes. And
oh, right, economists and their perfect little world.
Exactly. But let's be real, taxes, they're a fact of life.
Right.
And in the real world, in the world of finance, taxes, they change everything. When you bring taxes into the mix, this whole debt versus equity thing gets a lot more interesting.
Okay, all right, I'm hooked. Tell me more.
Okay, so think about it this way. When a company uses debt, they take out loans, they got to make interest payments, right? Well, those interest payments, those are what we call tax deductible.
Oh, right. So it's like the government's giving them a little discount for using debt.
Exactly. A little financial incentive. Those interest payments, they lower the company's taxable income, so they end up paying less in taxes overall. But here's the thing. When a company pays dividends to its stockholders, well, those dividends, those come out of after-tax profits.
So it's like debt gets a little tax break that equity doesn't.
You got it. And that little difference, that can make debt a more appealing option for companies, at least when you're looking at it purely from a cost of capital standpoint.
Okay, so debt might look a little cheaper in the tax department, but I have a feeling there's more to this story.
Of course. You're catching on. It's not as simple as saying debt's always cheaper, so just load up on loans. Even with that tax advantage, you can have too much of a good thing,
Too much debt, and things could go south.
Exactly. Imagine this. A company, they take on a ton of debt, thinking they're being all strategic with those tax breaks. But then, what happens if their earnings take a hit?
Uh-oh.
Exactly. Suddenly, they're on the hook for all those interest payments. And it can become a huge burden. Those cheap loans is not so cheap anymore. It can even, in some cases, lead to,
Bankruptcy?
Yeah, it can get messy. So it's this balancing act. Companies have to find that sweet spot using enough debt to take advantage of the tax benefits, but not so much that they're putting the whole company at risk.
So it's like walking a tightrope. One wrong step and...
Exactly. And this is where the Modigliani-Miller theory, even though people often simplify it down to debt versus equity, which one wins, it's really so much more nuanced than that. They weren't saying debt's always good or equity is always the way to go. It's more about...
understanding the trade-offs.
Yes. It's a framework for thinking. Companies need to consider their own situation, their industry, how much risk they're comfortable with, and a whole bunch of other factors.
So it's less about a simple equation and more about making strategic decisions.
Yeah, exactly. Modigliani and Miller, they gave us a much better map for navigating this whole world of corporate finance. It's complex, but their work, it's still so relevant even though it was developed decades ago. It's amazing how much their ideas still hold up.
It really is. So if you could give our listeners, one big takeaway, one key idea to remember from our little Modigliani-Miller deep dive, what would it be?
Ooh, that's a tough one. But I think the most important thing is to remember that every company is different, and there's no one right answer when it comes to financing decisions. What works for one company might be a disaster for another, you know?
So no shortcuts, no magic formulas.
Nope. It's all about context. You got to look at the big picture, understand the company, the industry, the market, everything. And that, my friend, is what makes finance so fascinating. It's like a giant puzzle.
I like the way you think.
Yeah.
All right, so we've tackled the why behind a company's financing choices. But now I'm curious about the how. Where do investors even begin to find information about a company's financial strategy? How do we know if they're playing this debt equity game wisely?
Great questions. And luckily, there's a whole world of financial statements, reports, and data out there just waiting to be explored. But it can definitely be overwhelming to navigate, even for seasoned investors.
So what's our next move? Where do we even begin to untangle this web of financial information? It's like those treasure maps, right? X marks the spot, but first you got to find the map, decipher the clues.
Exactly. You need the right tools and the right knowledge to navigate this world. But don't worry, it's not as intimidating as it sounds.
So where do we even start? What are some of those essential tools and resources for becoming more financially savvy?
Well, for those who really want to get into the nitty-gritty, there's this book, Principles of Corporate Finance. It's a classic.
I've heard of it. It's like the finance Bible, right?
Pretty much. It can be a little dense, a little dry, but it's the gold standard. If you really want to understand the ins and outs of how companies make financial decisions, that's the place to start.
Okay, so that's for the serious students. What about those of us who learn best by, doing? Any recommendations for getting some hands-on experience?
Absolutely. There are some really cool financial simulators and online tools out there. Like one that comes to mind is the Wall Street Prep platform.
Oh, yeah, I've heard of that one.
Yeah, it's pretty popular. They have all these courses and simulations on things like financial modeling and valuation. It's a really fun way to kind of put these theories into practice, see how they play out in a safe, simulated environment.
It's like a flight simulator, but for finance.
Exactly. You get to crash and burn without any of the real-world consequences.
Sign me up.
Yeah.
Well, on that note of taking risks, at least in a simulation, I think it's time for us to wrap up this deep dive. But before we go, I want to thank you so much for joining us today. It's been such a pleasure picking your brain about Modigliani Miller and the cost of capital.
The pleasure was all mine. It's always fun talking shop with a fellow finance nerd.
And to our amazing listeners, thank you for tuning in to another episode of The Deep Dive. We hope this episode has given you a new perspective on the fascinating world of corporate finance. Remember, knowledge is power, so keep asking questions, keep exploring, and never stop diving deeper.